Hello everyone, Mark here at TSLA. It's the 18th of July, the day before Tesla's earnings report being released, and Tesla closed up today, $293.34 for a slight 1.02% gain. And what I want to talk about today is basically a preview of earnings. Like, it's not going to be really a fundamental analysis, but kind of understanding what the price action was today, could be tomorrow, what the reaction could be depending on the results, and we'll go over some expectations. First things first. So here's the chart. You can see on this time frame, this is the hourly, that a lot of green candles. It did what we thought. It's only going to go two ways, right? Up or down, obviously. So when it peaked above the downtrend, the large time frame downtrend, which is this white diagonal line, it got up to around 295. It sold off down to 294 and closed around 293. And so this kind of is what we expected, that if it was to break through the trend line, you would then see a little bit of selling. It's not going to close above 294, and I didn't expect it would, and it would come back down a little bit. Now this move, and we'll talk about it after we look at the expectations of the earnings report. This move would have been a lot different if some bigger stock market wide or macro-ish things happened differently today. But let's go over to our browser, and we'll take a look at the expectations based off investing.com's article for the preview of Tesla's earnings. So looking at here, it says Tesla's Q2 earnings preview, and I'll just read a brief synopsis, which is basically the opening paragraphs. So the market is focused on the long-term Tesla story amid competition, tighter margins, positive surprises in revenue partnerships, regulatory credits could offset shrinking margins in the first half. Tesla's record production in Q2 raises questions about sales sustainability and potential risks. Instead, analysts will be keener to assess whether the long-term story remains on track in the face of increasing competition and tighter margins. This means, as is in quarter one, a negative EPS surprise can easily be offset by the message that despite the still challenging 2023, a bright 2024 is on the horizon. And so that's everyone's kind of standpoint, is that, okay, everyone's thinking that the earnings will miss or the margins will miss, and that what the price action will look like is going to be, it's going to look positive if the guidance of the rest of this year and 2024 is going to be increased or just looks good, or if you're going to have some information about what the delivery date would be for the Cybertruck. I don't know if we'll really get pricing about the Cybertruck. I'm not sure we'll even get a firm date on when the handover event will be and when the first deliveries will be. But what you're kind of trying to understand is their general idea of how the ramp is going to work. Meaning, are they able to produce from the get-go, tens of thousands of cars? Because Wall Street's only estimating a couple thousand Cybertrucks will be created in 2023. A couple thousand. So let's say they start production now. For the rest of the year, let's say it's 5-6 months, they're only going to produce like a couple hundred a month. And if that's the case, if there's guidance for tens of thousands of trucks, and obviously we know there's almost 1.9 million reservations people have paid for the Cybertruck, then all of those orders will be fulfilled, and the overall production number for the year could easily be somewhere in the range of 1.9 to 2 million cars produced by Tesla. So that would be really, really interesting to see if there's any commentary about the Cybertruck. What other people are talking about as well is how Tesla can bounce back from a bad margins miss, or if there is if they miss on the EPS, that if it's showing growth in other sectors of the company, meaning energy and whatnot, or even some guidance about what is the supercharging revenue gonna look like in 2024 when all these other manufacturers start providing adapters for their EVs to their customers in 2025, when those manufacturers actually do native installation of the NACS port on the car. Some guidance about how no one really knows these deals that are created and signed up for Ford and GM and and Rivian. We don't really know how Tesla's going to capture any revenue from that, but there obviously has to be, and guidance there could be also another kind of upside surprise, along with likes of energy and services, that if those segments of the economy, I'm sorry, of the company are improving, even if the margin is lower. So looking at this graph, you can see kind of how there's been this drop in gross margin over the last couple quarters, 19.3 being the one earlier this year. And that was really alarming for a lot of people and really hurt kind of the stock. And a lot of people were surprised. But we're pricing in so much lost margin that the street's somewhere around of 18.5% or 18% as far as the best case scenario for margins, with other people being much less than that. Analysts being somewhere in the range of 16, worst case scenario maybe 15. But these are all realistic numbers because we don't really have a firm idea of what these discounts costed Tesla, and we don't know how much Tesla was able to capture via maybe cost reductions or whatnot. So this is an article, by the way, from investing.com. It's really detailed. It's not necessarily biased any which way. So the estimate for Tesla is going to be 82 cents a share. I've heard some people that are more Tesla fans and whatnot, but around 86 cents a share. Here's the estimated revenue as well. So 82 cents for the EPS, 25 billion in revenue. And what you see in these EPS revisions over the last couple months, most of the people that are tracking this stock and doing analysis for it have definitely been very, very bearish on the overall prospects of this company. And so these lower EPS estimates gives us a chance to beat on the EPS. But really, margins really matter. And then guidance really matters when it comes to production numbers, along with maybe the idea of what we'll be making and making off of the back of the supercharging, and maybe some idea of what, how FSD is being picked up, maybe some ideas of has anyone reached out. And it's one of the popular questions on say.com for the Q&A portion of the earnings report that'll be on a teleconference, is a lot of people are asking, like, okay, is anyone approaching Tesla to license their software for OEM vehicles that they're producing? And that would be really interesting. I just don't know how that works without the hardware that is kind of required to run, let's say, full self-driving, autopilot, and whatnot, cameras, all the wiring for that, and all the chips and the processing units. Like, what does that look like if a company wants to incorporate the Tesla full self-driving into a totally different vehicle? Now, I can understand if the software that they're actually looking for is just the basic operating system that runs the center console display and the heads-up display. If that's something that Tesla is really keen on licensing out, I don't have a problem with that. That's just no different than Android operating system running on all types of different phones. And Tesla can be the operating system programmer for the rest of the car market eventually. Because what it does is that if you want to sell a new car with really advanced technology, basically software, that's very resilient, very easy and friendly to use, but also localized for all these different languages all over the world, and something that's updated constantly, so you don't have to tweak the language package. You don't have to tweak over-the-air updates and whatnot. You can just do it. You're hands-free, and you pay the licensing and some type of maintenance fee per car or whatever to Tesla, and they'll handle all the programming and all the updating for you. That will let you concentrate as an OEM manufacturer just on manufacturing cars. And I think that'll be a huge boon for Tesla because, software margin, that's what we want from this company. Tesla's operating on what 10, 11% margin overall for the company. So if you can get software margins into the mix, because you are basically just selling software wrapped around with an aluminum steel body that is a car, you can get 30% margin pretty easily. And that's what they're kind of looking for when it comes to full wide acceptance of and adoption, of full self-driving software. So overall, though, most of the market seems pretty bearish. And if you were to scroll down to the end of this article, their estimate is that the average estimate for price targets among analysts and banks and brokerages is around $260 a share. There's barely anyone that's above the target. I mean, no one has really a target price above the current stock price of $293, and you can kind of see this on the range of price target estimates. 315 being the highest, and there's maybe a couple people at 300, but everyone else is pretty much below what the current price is, and their average downside. I mean, the average for all the downsides based on the targets is around 10%. Now, a 10% move would be kind of in the estimated move range for Tesla after earnings, which is plus or minus probably 10%. Ironically, it doesn't really move that violently. And I talked about it in another video where, Tesla's doesn't necessarily, it's high beta, but sometimes doesn't move on the overnight pricing action in that kind of outside of that range. It will definitely move within the range from most earnings reports, the results of earning reports. So, that's why option plays on Tesla on a weekly basis, like on a call or a put option that expires on this Friday, most of those go worthless because, unless you're really buying in the money area at the money or whatever, then you won't really see anything other than 100% loss when you wake up the next day. It's 9:30 in the morning, the market's open, and the option that you paid $300 for, hoping Tesla would move 10%, is now 5 cents or something like that. Now, it doesn't mean, and this is not financial advice, it doesn't mean it won't go above or below that estimated move range. It's just that it doesn't tend to, and for one reason and one reason alone. It doesn't mean that even on the best news, right? Even on the best news, Tesla has a really good run. How much of that's really priced in? But secondarily, really, the issue is there's so many options, right? There's so many options that it might not make sense for Tesla to move outside that range, because it would just cost the market makers so much money to pay out these options if they all become in the money. And we know that Tesla is one of the highest traded single tickers when it comes to options volume. Because so many retail investors are investors in Tesla, more so than many other stocks. We outweigh the institutional investment, which is kind of crazy because this is a mega cap company. But yeah, let's take a look at the volumes. Let's go to Max. All right, so we're on MaximumPain.com, and we'll go to options, and we have Tesla loaded up here, and we have the expiration for this Friday, and you can kind of see where we're at with the open interest. This is the first graph, the open interest of where people are buying options at. So obviously, there's a huge call wall. Meaning a call wall is when you're looking at a chart that has these vertical measurements. A call wall is meaning the price doesn't want to necessarily move past 300. There's 50,000 open interest for this particular expiration in the strike of $300 a share. If you are the market maker and you're selling calls at the 300 strike price, you do not want Tesla to go to 300. Because then you have to pay them all out, or you lose your shares, or what have you. And here, and let's look at what's the low end look like. Well, the low end seems like there's 50,000 as well at the 270 strike point for this expiration this Friday. So we're kind of we're at 293 now. So if we were to look at, we're right around here. Let's say we're right around here, and the downside is going to be $22 a share, or something range of 7%. I don't know exactly. And the upside is going to be pretty much capped at 2%. That's the kind of the issue we're at hand. If we can only move up 2%, then be at this wall, what would that look like? Well, you can kind of understand if that's really going to be in play. So let's say you're watching the price action tomorrow, and the report comes out and it drops big or pumps big. What you want to understand firstly is, okay, so if it was to go up a lot, and you can do this by turning the extended trading hours on your trading view chart. If it goes up a lot and sells off immediately down below 300, then you know one thing is that the calls that people are buying at 300, the strike price at 300, those are not the calls that the market makers own. Those are the calls that market makers have sold. Now, if you see the stock rally really big past 300, it doesn't have this kind of like sharp reaction that just drops you down under 300, then you know that, okay, maybe the reason why the price is going above 300 is because the market makers, the people who are selling options and what have you, they own 300 strike calls themselves. They're long the stock at this higher valuation. Okay, so what about the other side? Let's say if it goes down. Let's say it goes down big. Let's say it goes down to 270. It does like an 8-10% move, and it hits 270 and it bounces up. Well, this is not financial advice, but I would be putting buy orders at around the 270 mark then, and buying a couple shares, because there is a floor that's working in the short term that's keeping Tesla above 270. But not only that, even at 260, which would be a very sharp move down, let's say it's going to be a 10% move down, then there's another wall, or really a put floor, but let's say just put wall of a bunch of puts that are out there that is keeping the market makers from wanting it to go too low, because they don't want it to pay out and pay for all these shares. Because the idea of selling options is not to let them go in the money, obviously, right? You don't want anyone to profit from what you're doing. You want all the profit yourself, and that's all the market makers are doing. So that's the thing. So these are going to be some pretty big contention points when it comes to trying to put in some put support floor for Tesla if it was to sell off severely. But the reality is, if you're looking at the open interest for Tesla, you're seeing a lot of puts all the way down to $180 a share. There are a lot of puts. Now, the thing about it is, like I mentioned, if the pricing moves through these walls, quote unquote, it's because either the stock is just so bad because of the results of the report, or that the people who own these options are the people who have a lot of money. Usually, brokerages, banks, funds, they want this move to happen, and so they can get their options in the money. Let's look at the volume chart. Now, the volume chart is how many people are purchasing these particular options, and this is probably mostly today. I haven't been watching it on a daily basis, but let's kind of take a look. Now, the first thing you see based off this volume chart is obviously that when the people that are buying these options, most of them right now are very, very bullish. The reason for the obvious bullishness in this is because the red volume areas are very, very low in comparison to the very, very green and spiky calls. That's it. Now let's look at the two peaks. They are, of course, 300 and 290 again. And a lot of puts in the money in this area, but a lot of calls too. So if you sold a bunch of calls today, and there's so many there's tens of thousands at 287, 290, 292, 295, and 300. What are you wanting this to do? The sweet spot when it comes to determining the real max pain is, I would take a look at the volume chart, see where there is the lowest trough of puts and calls. So there's a lot of puts here. You don't want to pay those out, but there's a lot of calls here. So ideally, and this is going to be brutal if it happens, you want a kind of a lower but flattish result by the end of the week. It doesn't have to all happen tomorrow night or Thursday, because these expire on Friday. So you kind of want to scare people and put it right here where no one is going to make any money. So we close at 292-ish, 293 today. So we're right around this point in this area. And if you were to sell off, and let's say you bull up tomorrow, let's say we end up near $300 a share. But if you can sell it off back to around 286, right here between these two strike points, you're going to really mess up a lot of people. So this is the area that if I'm in a market maker, I'm putting the shares at, the price at, I'll create a floor or buying somewhere around here, and I'll sell off everything here and just take profit if I have some. And obviously, they're obviously going to just try to put the price here either by shorting or selling. So these are the options. So this is kind of telling you that as much as you want Tesla to go up, there's a lot of calls recently that are coming in and being bought. The difference between open interest, these are just open interest orders that haven't been filled. Here's the volume of orders being filled, and a lot of these are calls, and a lot of them, mean, look at this. There's just no way. I mean, I just don't see how any of this gets filled. Yeah, and it's going to be interesting because the report can negate any of these walls. If the report is just so amazing, it doesn't care about the walls. It really doesn't. But what you want to do, let's say, and like I said, we have 2 days for these options to kind of work themselves out, because the market is going to have them expire on end of trading on Friday. So you have some time as a market maker to manipulate the price to end up where you need it to be at. And also tomorrow, since the options will be cheaper because it will be the day of earnings, you're going to have a lot of people buying options tomorrow, which will kind of skew this. I wouldn't be surprised to see more hedging. I wouldn't be surprised to see 270 puts being purchased on the day tomorrow, just to cover your butt. If you're really, really heavy Tesla, you kind of want to have insurance per se. Now that gets to the next point. How do you hedge Tesla? Now, we've talked about selling calls. So obviously selling calls is a no-brainer. And based off this chart, you can see that, there's a lot of calls at 300 and 290. So any calls, this is not financial advice. I don't want you to get mad at me if you lose your shares. But any calls sold above 300 looks like that's really not likely to get called away, just because there's so many at 300. Like I mentioned, though, if the report is good enough, you can kiss a couple percent change goodbye. It would be like a 9% move to the upside or downside. So what I really want to let you guys know is, the risks are, if you were to sell covered calls against your shares, they can get called away for less than the value of the price of the stock that very day, because, we don't know. This is the unknown part. You're just trying to hedge it. You're trying to hedge the unknown. So I know you guys know the covered call stuff. I talk about it a lot. But the thing about it, we know that every earnings causes a spike of implied volatility that increases the value of options, right? Because there's such a big unknown factor, and the market makers don't want to get screwed. So they're going to collect a lot of premium from you, okay? The person who's buying options. And then when the event passes, then the unknown is now known. And then the volatility will come in, meaning that your premium of your options will crash in value. And that's the idea of selling calls, just because if you sell a covered call after the event, most likely, it doesn't happen all the time, but most likely the IV crush will work in your favor by giving you a large buffer, because number one, the volatility would lower the value of the option, remember. And even if let's say the stock goes up, it'll give you the chance, if the volatility comes in, to buy back your call for a cheaper price than you sold it for. Or if the stock crashes, then of course your call that you sold will become worthless much, much faster, because if it's going down, the volatility comes in, and then the stock price will go down, and then of course a covered call will increase in value. Now, it really depends on a lot of things, like how close dated the covered call is. Closer dated would have less value, but it'll go worthless faster. But if the stock was to go up, the covered call could, the volatility could remain, meaning the value of the option, the premium, stays mostly the same, and then the stock goes up, meaning that the value of the covered call goes up, meaning it's harder for you to buy back and then risk losing the stock. So just be really, really aware of that. Now, how do you get around the IV, the implied volatility? That's really problematic, because it doesn't effectively let you hedge if you can't sell covered calls against your shares. Let's say you only have a handful, but you want to hedge. If you were to buy puts, it suffers that implied volatility crush too. So remember, because the move has to be like at least 10% out of the current strike price that day. So let's say Tesla closes at 295, you have a 10% up and down from 295, this area, this window, that pricing needs to move out from under if you have puts, or over if you have calls. So if you are trying to hedge with puts on the Tesla ticker itself, it becomes problematic, because you can lose both ways, where the price comes down on the stock, but it doesn't come down enough to get out of that implied move, right? And then your put, even though the price is going down, your put becomes much, much less in value, because the premium just disappears on it. We're talking that sometimes the implied volatility can come down 50%, from where it was. So let's say you're buying options at 90% volatility, the next day they're at 42%. It's brutal because it really, really lowers that value of the option. And you lose both ways, like I said. You lose both ways because the option that you have is not protecting you from the downside because it's losing value. And then the share price also loses value. It's kind of important that to sometimes, like when you're buying shares, and I know not everyone can do this, and it's not fair because, the share prices are so high that, having 100 shares or something lets you sell calls against it to kind of limit your downside. But what can we do to get around the volatility crush? Now, I'm not saying that this is the best way to do it. Okay, let me look at this different ETF site. Okay, so here's the ETF site I was looking at, which is ETF.com. And you can kind of search for ETFs that contain Tesla in it. Now, the thing about it is, since the ETFs are made up of many different holdings, it's not just Tesla. Though there are some, okay, let me take that back. There are a couple ETFs that are just Tesla, and you'll see them here on top. TSL and TSLA. And there's another one, which is going to be TSLQ, which you might know. So TSLQ is the 100% inverse of Tesla. So there's a couple things you kind of want to know about these just pure Tesla ETFs. Firstly, so the TSL and TSLL, and what you don't see right now is which is TSLQ, which is the inverse. These aren't really subject to, they don't really have that same problem of volatility crush since they're just, equity, there's shares. If you want to go long Tesla, you can go long with a leverage ETF. Just be really careful. These are leverage ETFs. They're meant to be held for very short periods of time. Because with the nature of the leverage ETFs is that there's this idea of decay. Not even an idea, it's just a reality. Where the up and down movements of the stock, intraday, intra-week, or intra-month, whatever time frame, it would slowly lose value. The moves are not equal to that of this stock. The way they're getting this leverage is that loss is there. So let's say if you're to hold TSL for 6 months and you to hold Tesla, the actual stock, for 6 months, even though you're trying to get that 1.25 leverage effect, because of the movements are up and down, that you'll actually not realize a 1.25% performance against Tesla. So just be really careful. The idea of leverage ETFs, be it SQQ, TQQ, SOXL, or these Tesla leverage products, they're just there for very short-term holdings to capture a move, kind of like you're trading options per se. But you get into leverage situations with these kind of ETFs. You get into them because your conviction is good and you don't want to suffer theta or some type of IV crush from an option. So going long via ETFs sometimes can work better for you for one of two reasons. The aforementioned reason, you're not worrying about theta or you're not worrying about IV crush. But secondarily, the flexibility of when you can kind of sell shares. Now, I understand that Robinhood is doing 24-hour trading now, but not everyone is using Robinhood. And the Robinhood liquidity is just based off the Robinhood app customers themselves and people who might be using the Ocean broker that Robinhood uses to process those 24-hour trading orders. So let's say you are listening to the call and the report just came out tomorrow and Tesla is doing a sharp tank. It's down 10%. Well, if you have strong conviction of the stock that this move is not, that move is just not, commiserate with what the report is, and the call might change fortunes, that you can buy TSL or buy TSLL after hours, okay, and then take advantage of that move up if there was a move up during the overnight or a move up during the earnings call, which happens after the report is being released. And also another way is if you're already long, let's say you wake up tomorrow morning and you think that, Tesla is undervalued. And then you feel from your research that you need to go long on Tesla, regardless of whatever price it is, not financial advice. These products, like I said, they give you the flexibility to get out after hours if you have a strong conviction because you want to leverage play. And secondly, that flexibility to sell if things are going bad or going good. So let's say it's the reverse of our hypothetical scenario, that Tesla is mooning after hours. It's going up a lot, and you are holding hundreds of shares of TSSL. Well, then you can get out. You can get out immediately. So if you're holding call options, you can't get out until the next day. And you didn't even know, we can't even do the math to see what type of volatility there would be for that option. We don't know the value of it. So having those products lets you take advantage of the move and get out, or take advantage of a move that happened already to go the other way. Now, like if you believe that if Tesla moons that it's going to come back down, like I mentioned, there's that TSLQ ETF, which is the 1-for-1 inverse of Tesla. So if you, let's say, and we've seen this happen with JP Morgan, we've seen it happen with like Citibank, we've seen it happen recently with earnings, where the earnings are seemingly good, but what happens is the move the next day is completely opposite. Even you'll see the move maintain, like JP Morgan held a nice 4% move during pre-market, and once the market opened, it just completely sold off. Now, you can protect yourself against that. Let's say Tesla's up 10%. Well, that's a great move already, right? Like, how greedy do we want to be? Imagine if you could do this. You could buy TSLQ when it's 10% cheaper after hours, hold it overnight into the open, and what if Tesla tanks in the open? And then you're protected against the downward movement. And you can say to yourself, you limit your upside. You do limit your upside if you're trying to short with these shares, but then at the same time, you just captured a 10% move. And you can get out of these things without any theta loss. So ETFs are a great way to take advantage of the move that you want without having to worry about theta loss of the options. But at the same time, if you do want the option, if you want that leverage, if you want that explosive leverage, if you need it, then there's options to buy options for ETFs who don't have the same necessary volatility of Tesla's earnings. Because let's say you want to go short Tesla to hedge your shares. Well, if you look at, we sorted this table by the allocation of Tesla within the ETF, and we can see that XLY has a 20% holding of Tesla in it. Now, I know that you're not going to get a 1-for-1 movement on Tesla if you're to short XLY as your hedge. But at the same time, you're also not having to worry about a bigger volatility crush after the fact. These options will be much cheaper than Tesla's, and you can then kind of see how Tesla could honestly affect the rest of the sector to bring down the other parts of the sector and then make your hedge more effective, even though it's only at 20% weighting in XLY. And we can see that there's a 15% weighting in ARQ, which is, of course, from ARK Invest, and an 11.28% weighting in the bigger fund, the ARK K. Now, so these are kind of options. If you want to go long, if you want to go short, you don't have to necessarily do it through an ETF based off Tesla or Tesla itself. If you don't want to risk too much implied volatility crush, you can use options that contain Tesla to as an option to hedge. Now, this is not financial advice. You need to do your own research. You need to use tools at your disposal to see how effective these could be at possibly hedging your shares and not have to spend an arm and a leg for it to be worthless due to IV crush the next day. Now, word of warning when it comes to these ETFs, as you can see, let's look at the market value. These ETFs, okay, they are not very liquid other than XLY. And, I would have expected actually RK to actually be a little bit more assets under management, AUM, but it's only at about $1 billion. And this used to be much more liquid. If you're looking at options recently for ARK, they're a little bit, the bid ask on that is a little bit wider than I'm used to. I haven't looked at it in a long time. So here's some warnings about trying to hedge or trying to go long via ETFs, is that the shares would be very, very difficult sometimes to get accurate, good fills. Because I look at TSL, it only has 8 million in assets under management. TSSL is a little bit more. This could be a little bit more liquid because it's mostly people who trade Tesla. What about XLY? So this is a good bet because this is $3.5 billion and RK is $1 billion. RQ is very, very low in assets under management, but it has a higher weighting. And you can just use this chart at ETF.com to kind of see how you want to capture your Tesla move. Maybe this is a better option if you're trying to trade or day trade this stock for earnings. Now let's go back to the chart and we'll just take a look real quick about some price action and why things happened today the way they did. Now, here's the hourly. I did mention that, okay, yeah, it kind of did what we thought it was going to do. We drew these squiggly lines yesterday of the two possible options, not options, but two paths that the stock could take. It was possible that it would go up through the downtrend, down by the end of trading day tomorrow. It's possible to settle here in this circled area. We can also go down, which was actually it was going down today, and then come back and sit on the downtrend, or it would have sold off and stayed sold off flat for the rest of today and tomorrow. So that's the thing, that it kind of did what we expected it to do. So no surprises there. The question is, does it do what we continue to think it's going to do and sell off into earnings and then put you at a pivot point? Does it gap down tomorrow and close back at the downward trend line? Possibly. We don't really know, but right now it's looking like we're kind of in that area of this is where the price would be at. We know there's a lot of calls at 292.50, 295, and 300. So a move up to 300 would be a 2% move. That's not a lot. Now you can see that intraday for Tesla. So let's say you get 300 on Tesla. You have to start making decisions to yourself. If you're trading this name, do I buy a bunch of TSLQ? Do I buy some type of hedges? This could be the entry for hedges because this might be the highest price you'll see because we know there's so many calls at 290, 295, 300. What if the market knows, okay, look, the market makers they're really worried. They were trying to keep pricing. You could tell. Let's look at a lower time frame and you can see what we're talking about. Looking at a lower time frame, this is the minute. I'm sorry for the drawings that are being maximized all over the place right now. But let's look at the beginning of the trading, which is right here. So all this area here, let me highlight it so we can kind of understand. So this is the consolidation that happened during the course of the day. Now, what is this? So it kind of comes down, but what is this price here? Like, where are we? What is this? If I was to kind of maybe put like our cursor here at the kind of like in the middle, the median, it was at 288. This is the perfect place. If you're the market maker and Tesla's been going up for the past couple of days, you kind of are doing everything you can. You're selling it off like crazy and you're shorting like crazy. And you unfortunately, like you're like, dang, they found buyers at 286 and it's coming back up. But you're able and trying to manage it somewhere here in the 288 range. Because what is 288? It's below 300. It's below 290. It's below 295 where a lot of calls are sitting in that area. So from here, this is 290 right here. All of this and up, all of that and up, you don't want any of that to happen. You're trying to keep it here and you're doing a pretty decent job of it. And then something happened. What happened? It was Microsoft. Microsoft happened. And you're asking like, what does Microsoft have to do with anything about it? Well, it doesn't really have much to do about it at all, other than the fact it's an AI-based move, meaning that Microsoft came out with a product that what they weren't charging for, which is Copilot, and now they are going to charge $30, $35 a month for this service, which is AI-based service with Microsoft. Now let's look at Microsoft and kind of understand the move that happened today, and maybe we can explain to ourselves what happened, why it happened, and that this was not something the market was planned for. The market was, so if you want to know what it was planned for, this is what the market play was, and it worked out very well for me, is that market's looking for breadth, right? It wants to show a little bit of breadth, which is of all names participating in the rally. So it looks healthier, right? So we had some good bank reports come through as far as earnings go. They were very decent. XLF is going up. KRE, which is the regional banking, is going up. Charles Schwab had a huge day. So all these smaller names in the IWM, the Russell 2000, were causing that index to go up. Now, we saw some bounces in telecommunications and, of course, the banking. So the Dow was going up a little bit as well. But all of a sudden, in the middle of the day, Microsoft came out with that news and that press release saying they're going to start charging for Copilot. And what happened with Microsoft? It had an incredible move. And within minutes, we're talking 1 hour really, it did a 6.5% move from being red. Now, we have three comparative lines here. The orange line here is Tesla. The yellow line is going to be the NASDAQ ETF, the QQQ. And then we have NVIDIA in the light blue. Now, Tesla was ranging just like Microsoft was all day long. They're trying to suppress the pricing. The QQQ was red all morning, while the Dow and the IWM, which are the other ETFs and of the indices we talked about, they were green. Now, so all these names, all four of these names, Microsoft, NVIDIA, QQQ, and Tesla, were all just sitting here, just being red all day long. Press release comes out, Microsoft shoots up. Now, and all of a sudden you see a very sympathetic, slightly delayed move from NVIDIA. People are kind of processing this. If Microsoft is charging people for AI, does that mean that they're finding a good use case, a business case, for all the investment they're going to put in to buying semiconductor chips? Okay, perfect. They're monetizing AI. That means NVIDIA goes up. And you're seeing NVIDIA have a nice sharp move up, maybe 2% for NVIDIA. A very strong day because it's already so high and it just doesn't stop going up. The QQQ, the NASDAQ, at the same point in time, starts trending up. And it starts trending up. And it starts trending up all day long. Now, what does that mean? They really tried to suppress Tesla because you can see here, even at an hour or 2 hours in, or hour and a half in, from that big Microsoft move, Tesla's still very much flat. But I think what's happening here is that in the indices, the S&P 500 and the QQQ, there's getting too many people buying into it. And if you buy the QQQ, you're essentially buying all the components. And Tesla starts moving up, and it moves up very sharply. It's doing its beta thing, 1.8 times the move of the index, and it's doing it, and it was bought up for the rest of the day. This is not something necessarily the market wanted to happen, like I mentioned. This was very much on purpose to keep pricing. They don't want to pay out in the 290s. They don't want to pay out in the 300s. So this move was a surprise for a lot of people. This took a lot of people off guard because to the point where there was so much rotation into these tech names that the Dow and the IWM were not performing well compared at all. And it was a better S&P 500 move, it's a better QQQ move, or NASDAQ move. So this move, we don't know if this is really organic. I would have said maybe not, but it did illustrate our technical analysis, quote unquote, guess of how the pricing could have worked, and it kind of did exactly what we thought it would be. So going back to Tesla, everything's going to be kind of based off what tomorrow looks like. And tomorrow can give you the entries for the type of move you're looking for. If Tesla hits 300 tomorrow, if it hits 295 or 297, are these your opportunities to go short? Because we know how many calls are above those strikes. But what if Tesla opens and gaps down? What if Tesla opens it again back at the 288 mark? Number one, it kind of gives you the idea that, the market is really trying to suppress the pricing. They don't want to pay out retail's calls. They don't want you guys to make any money if you're long. They just don't want to. So if you see it open up at 288, what could that mean for the rest of the day? Maybe you see it sell off all day long back into the lower 280s. But what does that give you an opportunity to do? Now you can you play it for a move up to 290? Maybe that's your entry if you want to go long. So kind of be really on your toes tomorrow. Be really quick because you're trying to look for opportunities to hedge. You're trying to look for opportunities to short or if you're trying to look at opportunities to go long at a more affordable price, you look for those intraday moves, look for big moves, look for the pre-market action. Wake up early in the morning so you can kind of understand, okay, so it's 7 o'clock when pre-market opens. What is Tesla looking like? Download Robinhood to your phone, watch the price action on their 24-hour market for Tesla, and it'll kind of give you a good idea. Sentiment is pretty important because retail is such a large portion of holdings. That sentiment overnight can really kind of give you a better game plan of how you're going to protect your shares or trade better with good entries for tomorrow. So good luck to everybody. Thank you so much for listening. And I hope everything works out. I'm a big Tesla bull. So Tesla's most of like 90% of my holdings. I really hope we have a great report. All right. Have a good night. Bye.